let's now talk about what hedge funds mean when they say that there's a short squeeze, which obliterated many hedge funds over the past year when they were short AMC and GameStop. And a short is actually the opposite of a long. It's the opposite of owning a stock. And so when you own a stock, you're actually long the stock. And when you're short the stock, it's the opposite. Now, over the past year, hedge funds have shorted companies that were severely hurt by the COVID crisis. And hedge funds shorted movie theater companies and retail stores, which actually seems logical because if you think about it, those stocks should go down if everybody is at home and not allowed to go outdoors. However, if too many hedge funds short a company, then what happens is it becomes a crowded short. And if there's any slightly positive news on the company that they're short, then they can freak out and cover that short, meaning they get out of the short position. And if many hedge funds do this at the same time, then what happens is a short squeeze occurs. Basically, the stocks squeeze higher because hedge funds have to buy the stock and return it to whoever they borrowed it from. That's how a short works. Now, I don't recommend shorting stocks because your losses can actually be infinite. And I'm going to get to the short interest ratio here in a second. I don't recommend shorting stocks because your losses can be infinite if the stock goes up a lot. Instead, I recommend buying a put, which means you make a lot of money if the stock goes down a lot, but you only lose a small amount, the amount you pay for the put, if the stock goes up a lot. And I explain this in much more detail in my MBA degree program. Now, quite often, if a hedge fund is short a stock that goes up on bad news or does not go down on bad news, then they panic and get out of the position. So what data can we monitor to understand if too many hedge funds are currently short the same stock? So there's something called the short interest ratio, which mathematically is the number of shares that are shorted in the market divided by the average daily trading volume. Okay? A higher number means there's a chance of a short squeeze. And when I worked in the hedge fund industry, I was terrified to short any stock with a short interest ratio above 10, meaning it would take 10 days of short covering until all the short positions are covered. Now, the short interest ratios on AMC and GameStop are relatively low right now because many hedge funds have already capitulated or given up on their shorts. But I'll show you where you can get the information and how to calculate it, which is not always reliable. Okay, and there's a bit of a lag to this data as well. But what I'm about to show you, you can use to directly understand if the short interest ratio on a company is well above or well below 10. So what we're going to do right now is we're going to very quickly look at AMC and GameStop's short interest ratios. So what we'll do is we'll go here to my favorite free website, which is finance.yahoo.com. Never pay for any of this stuff, please. All right, and then what we'll do is we'll go to AMC first, and I'll show you the short interest ratio, and I'll show you GameStop as well. Okay, AMC, a big movie company. You go here, first of all, to statistics. Okay. And then you go to short interest. So let me just do a search on short. Here we go. Cool. All right. So right here, you can see the short interest ratio. Okay. And this is old data. Okay. And they get this from Morningstar, which is a data service company. The short interest ratio is 0.67. And what that means is the number of shares that are short divided by the average daily volume is quite low. Okay, it's not exactly 0.67 according to this data, but I'll show you. So right here it says the share short is $102 million. Let's just say $100 million bucks. Okay, and that's the numerator. So let's find out what the denominator is, which is the average volume of shares traded daily. So what we'll do is we'll go here to summary. Okay, and if we go down here, we'll see that the average volume is 146, call it 150 million shares. So 100 million shares, $100 million short divided by 150 million is well under 1. Okay, that's a short. That's a very, very small short interest ratio. It was way higher earlier this year and last year, of course, especially last year. when hedge funds were short in size, but they've all given up, which is one of the reasons why the stocks have ripped to the upside. Lastly, I'll show you here quickly, and then we'll move on. GameStop, ticker GME. So with GameStop, if you go to statistics and you scroll down, you'll see here the short ratio. Where is it? It should be down here. Here we go. Here. Yeah. All right. So the short ratio right here is 1.83, well under 10 days. Okay, so 1.83. And the shares short are about 12 million shares. And if we go to the summary here to see the average daily trading volume, so 12 million divided by 10 million, it's above 1, but way under 10. Okay, so the bottom line is that if a stock goes up on bad news or had a very high short interest ratio, then hedge funds could panic and get out of their short position, which could squeeze the stock higher, which is absolutely terrifying for hedge funds. I know that because I've lived it before.